Hello, our team is Group 10, and we will be presenting on the topic linking sustainability to profit, ESG, and CFP in Korea's capital markets. In today's presentation, we aim to explore how the concept of ESG goes beyond ethical and environmental responsibility to relate directly to corporate profitability. We'll especially focus on the unique context of Korea's capital market and share the key patterns we observed in our analysis. Our presentation will proceed in the following order. First, the introduction about Korea's financial markets, and second, literature review, and third, the data description, and the fourth, key findings. Let's begin with a brief overview of the strategic background of our research. Recently, corporate evaluation has expanded beyond measuring profits alone. Firms are now assessed based on the social value they provide and their environmental consciousness. In other words, non-financial performance metrics are becoming key evaluation criteria. In Korea, interest in ESG has surged in recent years, and companies now face increasing pressure to prove more than just brand image. In this sense, ESG is no longer optional, it's becoming a condition for survival and long-term sustainability. So here's the core question we asked. To what extent is ESG related to profitability? And under what conditions does this relationship change? Scholars and investors remain divided on this issue. However, some perspectives in Korean financial markets suggest that ESG can have long-term positive impacts on firms. For instance, a 2024 study by Lee and Lee found that ESG initiatives in certain Korean financial firms were linked to sustainable growth and improved long-term profitability. Here's why Korea's capital market is well suited for ESG analysis. First, we can observe concrete signs of decarbonization. Korea's per capita carbon emissions declined from 12.4 tons in 2015 to 11.7 tons in 2022. This figure is more than just the statistics. It reflects a broader shift across government, industry, and finance toward active climate response. Another reason is the growth of ESG-related financial products. For example, in 2023, Korea issued 18 billion in green bonds. This suggests that the environmental considerations are becoming critical investment criteria, not just rhetorical flourishes. We believe this rising demand for green finance creates a valuable opportunity to study the link between ESG and financial performance. The third reason is the government's reform. Korean firms have also shown consistent changes in the G component of ESG. The percentage of firms with outside directors rose from 45% in 2005 to 78% in 2023. This reflects not only an effort to align with global standards, but also a commitment to enhancing transparency and accountability. So ultimately, ESG is no longer a short-term issue, but is being redefined as a central pillar of corporate strategy. So is there actual evidence that ESG influences firm performance? One of the most compelling findings is that firm size and innovation level moderate the effect of ESG. When ESG scores increased by 10 points, small firms saw a 0.15 increase in Tobin's Q, while large firms experienced only a 0.06 increase. This suggests that the firm size may be a key moderator in determining ESG's financial impact. Another study yielded even more surprising results. ESG had a stronger effect in non-tech leading firms than in tech leaders. For instance, among 500 KOSPI and KOSDAQ listed firms, those that were not tech leaders but had high ESG scores showed 12-point higher average ROE. These findings move beyond the vague claim that ESG is good. They help clarify under what conditions ESG's effects are amplified or diminished. Based on prior findings, our team conducted an empirical analysis of the relationship between ESG and financial performance, focusing on the firms listed on KOSPI and KOSDAQ. Our data set covers the period from 2012 to 2023 and includes ESG scores as well as financial indicators such as ROA, ROE, Tobin's Q, and market value. This structure allows us to capture both accounting-based and market-based performance, giving us a multi-dimensional view of the financial value ESG initiatives create for Korean firms. Now let's move into our literature review, which summarizes prior research on this topic. There are two primary theoretical frameworks that explain how ESG affects corporate financial performance. The first is the stakeholder theory. This theory emphasizes that when a company responds to the needs of not only shareholders, but also a wider range of stakeholders, including consumers, employees, and local communities, it can build trust and achieve stronger long-term performance and reputation. According to Kim et al., this approach reduces long-term risk, protects the firm reputation, and ultimately enhances financial stability. The second is resource-based view. This perspective treats ESG capabilities themselves as scarce and strategic resources. For example, effective environmental management systems or robust governance structures are seen as internal capabilities that offer a competitive advantage. Park et al. Argue that such resources improve operational efficiency and help firms secure differentiated competitiveness. However, it's also important to note that the effect of ESG can vary depending on the time period, industry, and how ESG scores are measured. In other words, ESG impacts are not universal, they differ depending on the environment in which a firm operates. So, what does Korea's actual experience reveal? Multiple domestic studies show a strong relationship between ESG activities and financial performance, particularly with the profitability indicator ROA. Among the three components of ESG, governance factors had the strongest impact. For instance, in a meta-review of 38 Korean studies conducted between 2011 and 2022, governance was identified as the most influential factor on ROA, and it was statistically significant. While environmental and social factors also had positive effects, their impacts were comparatively smaller. However, these results do not apply uniformly across all firms and industries. For example, one study focused on Kosdaq listed firms found that while overall ESG scores, social and government scores had a positive impact on firm value, and environmental scores had a negative effect. Regional and industrial differences were also significant. In the machinery industry in Changwon, ESG scores were positively correlated with profitability, with a statistically significant coefficient of beta 0.237. In contrast, no such clear effect was found in the transportation sector. These results suggest that ESG effects vary substantially based on industry characteristics and external pressures. Firm size also emerged as an important monitoring factor. Take CJ Freshway, a small to mid-sized food distribution firm, for instance. When its ESG score increased from 70 to 80, its Tobin's Q rose from 1.2 to 1.6, which is a 0.4 point increase. By contrast, for large firms like Samsung Electronics, the same 10-point increase in ESG score led to only a marginal rise in Tobin's Q from 1.8 to 1.9. This difference implies that small firms may experience greater benefits from ESG initiatives, face lower implementation costs, and attract investor attention more easily. Innovation level is another critical factor. In the case of Hyundai Waya, a 10-point increase in ESG score led to a 1.2% increase in ROA. On the other hand, in a more technologically advanced firm like LG Chem, the same ESG score increase resulted in only a 0.4% ROA gain. And this suggests that the more technologically advanced a firm is, the more diluted ESG effects may become. Conversely, firms with lower technological capabilities may see greater profitability gains from ESG improvements. And finally, existing research still has limitations. Most studies focus on either KOSPI or Kosdaq, not both. There is also a lack of research on how the ESG performance relationship evolves over time. And moreover, ESG score assignment methods differ across agencies, so results may vary depending on which rating agency's data is used. To address these gaps, we adopted a fixed effects panel model in our analysis. And this model allowed us to control for firm-specific characteristics while better capturing long-term trends. Let us now introduce the variables used in our empirical analysis. So we begin with the dependent variables, which represent the corporate financial performance. We use three key indicators, ROA, ROE, and Tobin's Q. ROA, return on assets, expresses the amount of operating profit generated from the sum of all the assets currently held by the company. It can be said that ROA is an indicator that well reflects a company's financial performance. And ROE, return on equity, measures how efficiently the company is generating profit using shareholders' capital. A higher ROE indicates a greater investment appeal. And third, the Tobin's Q, it is an indicator that reflects a company's financial performance. Tobin's Q constructed using these elements, which is market value of assets and replacement cost of capital, indicating that a higher Tobin's Q value means higher market capitalization. Now let's turn to the independent variables, which we hypothesize to influence corporate financial performance. So we selected three main variables, which is governance score, paid and count, and ownership ratio. Governance score evaluates whether the company is being run with a transparent management structure, such as the efficiency of decision making, conflict of interest prevention, and transparency. Though typically presented as letter grades, A plus to D, we converted these grades into numerical values for quantitative analysis. And then the patent count is a quantitative indicator that shows how much effort a company is putting into technological innovation. And then the last variable, which is the ownership ratio. The ownership ratio of the largest shareholder represents the degree of ownership concentration. In this analysis, the variable was used to empirically examine how it affects financial performance. So we calculated the ownership ratios by aggregating direct and indirect stakes of the largest shareholder using annual reports from 2012 to 2023. For example, Samsung's ownership was estimated by summing Lee Jae-yong's direct holdings and indirect stakes via Samsung Life Insurance and Samsung C&T. And similar approaches were applied to Hyundai Motor, and for firms like SK Hynix, LG Chemical, Samsung SDI, and Hana Solutions. For KT&G, KT, Kakao, Hyundai Mobis, SK Telecom, we use ownership figures directly cited in the reports. We will now explain the methodology used in our analysis and present the key results. For the study, we employed fixed effects panel regression model. While this model may sound a bit sophisticated, it was essential to ensure the reliability of our results. The greatest advantage of this model is that instead of simply analyzing 12 firms, we were able to utilize 12 firms multiplied by approximately 11 years old of data, totaling 135 observations. By incorporating year-by-year changes for each firm, we maximize statistical power and uncovered patterns that would have been completely missed in firm-level regressions. For example, if we had analyzed each company separately, we would have only had 10 to 12 observations per firm. However, the fixed effects with the model we use allowed us to control for a firm's unique characteristics and focus on how changes in ESG scores within the same firm over time affect financial performance. So let's begin with the results from our first regression, which is the ROA model. The overall model is statistically significant with an F statistic p-value of 0.037, indicating that the variable included meaningfully explained ROA. Our main hypothesis concerned the interaction between ESG score and log patents. The coefficient for this term was negative 0.35, supporting our theory that the positive effect of ESG on ROA weakens as innovation increases. However, the p-value of 0.186 suggests that the result is not statistically significant. So we interpret this as an area for further study rather than definitive conclusion. Next, we present the regression results with Tobin's Q as the dependent variable. This model demonstrated far stronger explanatory power. R squared value was 0.49997, meaning it explained nearly 50% of the variation in Tobin's Q. And the F statistic p-value, which is virtually zero, indicating the model is highly statistically significant overall. The key hypothesis was the interaction between ESG score and size dummy, small. The coefficient was 0.294876 with a p-value of 0.027. Confirming our hypothesis, the positive effect of ESG on market value is significantly stronger in small firms. In other words, ESG initiatives may have more powerful value creating effect for small firms than for large ones. And other interesting results emerged as well. The value log assets showed a positive coefficient with level significance, which supports the idea that the larger firms tend to have higher market values. And also, the size dummy small had a negative coefficient, indicating that on average, smaller firms have lower market value than large firms. However, as ESG score rise, this gap narrows or even reverses, which is a key insight from this model. In summary, firm size significantly moderates the effect of ESG on market value as statistically verified by our analysis. This graph shows the trend of ROA by industry over time. From 2012 to 2022, ROA declined across all sectors. However, Industry 1 consistently maintained higher ROA than Industry 0, which is the red line, which suggests that industry structure itself may impact ROA performance. And the second graph illustrates how ESG effects vary by innovation level. Among the low innovation firms, which is the blue line, ROA rose clearly with higher ESG scores. And in contrast, for high innovation firms, which is red line, ESG scores had almost no effect on ROA. And this suggests that ESG delivers greater profitability improvements in non-leader firms than in established tech leaders. The final graph shows how the interaction between ESG and firm size affects Tobin's Q. As expected, large firms, red line, saw an increase in Tobin's Q with higher ESG scores. However, for small firms, T-line, the opposite trend appeared. These results indicate that the market may fundamentally evaluate ESG differently based on firm size, highlighting the need to tailor ESG strategies according to firm characteristics. And that concludes our explanation of the methodologies and key findings. So in conclusion, our analysis delivers the following key takeaways. First, ESG does not affect all firms in the same way. Its financial impact depends heavily on firm size and innovation level. Second, firms should avoid implementing ESG strategies in a uniform manner. Instead, ESG initiatives should be tailored to a company's specific position and characteristics. Third, small firms and non-leading tech firms in particular can leverage ESG as a strategic tool for growth. Ultimately, this research provides a meaningful insights for designing corporate strategies that balance sustainability and final performance. It also highlights the need for more sophisticated and context-sensitive approaches in future ESG policy development and investment decision-making. And these are our references. And thank you for listening.